In this video, we're going to talk about how to generate income if the market goes up, down, or sideways. So let's start if the market goes up. One way to make a return if the market goes up is by owning stock. That is, you want to go long on a stock. So you want to buy a stock at a low price, let's say at $40, and sell it at a higher price, let's say $80. In this example, your return on investment, or ROI, would be 200%. So that's one way. It's by owning stocks, buying low, selling high. So you can make a return off the capital appreciation of stocks. The second way to profit if the market goes up is by going long on a call option. So imagine buying a call option for $2 and having it going up to $10. In this case, your return on investment is 500%. Now granted, options do have risk. They expire, they have an expiration date, and they're subject to time decay, which decreases the extrinsic value of a call option. So when buying call options, you need to be right not only about the direction of the stock, but by also the amount that it moves and the time frame in which it moves. It needs to move significantly before it expires. But if you call it right, your potential return can be much higher than what you can get from owning a stock. So those are two ways in which you can profit if the market goes up. Now, another thing you could do is, instead of buying a call option, you could sell a put option. So instead of going long on a call option, you can go short on the put option. So imagine selling a put option for $5 and then buying it back for $1. So that's another way in which you can profit. You can sell the put option first and then buy it back to close your position, or let it expire. But with stocks and call options, you would buy first and then sell later. Now, in addition to selling a put option, you can also sell a covered call option where the strike price is greater than the market price. So not only will you be able to collect the premium from selling a covered call option, but as the value of the stock goes up and your option gets exercised at a higher strike price than the market price, you can also receive capital appreciation of your stock. So here's an example. Let's say that the market price of the stock is $40. And keep in mind, one options contract controls 100 shares. So imagine if someone sells a covered call option with a strike price of $45. And he bought the stock at $40. So he paid $4,000 for buying 100 shares at $40. And let's say he sells a call option, a 30-day call option, for $4. So it controls 100 shares. He's going to receive $400 for selling that call option. And let's say the price goes up from 40 to 80. That option will get exercised when the stock price goes above 45. Whoever bought the call option from you, if you sold it, they will want to exercise that option when it goes above the strike price. So you would have to sell your shares at $4,500. At $45, which you'll receive $4,500 for the 100 shares that you sold. So you're looking at a gain of $900. So that's an example of profiting from a covered call option if the stock were to go up. First, you need to buy 100 shares at market value, and then you could sell the call option. And then if it goes up and the option gets called, you would have to sell your shares at $4,500. So not only did you participate in the capital gains of the stock when it went from 40 to 45, but you also collected a premium for selling the covered call option. This strategy works if you believe the stock market is about to go sideways. That is, if it may go up a little or down a little. But if it goes up a lot, it's better to buy the stock at 40 and sell it at 80. Because if you bought 100 shares at $40, you're putting in $4,000. But if you sell 100 shares at 80, you're gaining $8,000 with a net gain of $4,000. So if the stock were to really take off, owning the stock will be better than selling the covered call option. But either case, you can still generate income if the stock market goes up. So those are 4 ways in which you can generate income if the market goes up. It's by either buying the stock and selling it at a higher price, buying the call option, or selling the put option, or selling a covered call option. All 4 methods can generate income when the market goes up, but you can get the greatest return on investment if you go long on the call option. But it's the most riskiest one to deal with. Now, let's look at the second scenario. That is, if the market goes sideways. So how can someone generate income if the market goes sideways? Because let's say if the stock is at 40 and it remains at 40. You can't profit from buying the stock because if you sell at 40, you're not going to make any money. So you can't generate income from the capital appreciation of a stock if it moves sideways. However, you can generate income by owning the stock if it's a dividend stock. So the company could be paying you dividends while the stock price goes sideways. The second thing you could do is by selling options. You could sell a covered call option, or you could sell a put option. A call option gives the owner the right to buy the stock at a certain price. And remember, each option contract controls 100 shares. A put option gives the owner the right to sell the stock at a certain price, that is the strike price. So those are the 2 ways in which you can generate income when the market goes sideways, is by owning dividend stocks or by selling call and put options. Now, when the market goes sideways, volatility is relatively low, so the value of call and put options will be low. So thus, even though you can generate income by selling options, those options won't be as high because the volatility tends to be low when the market moves sideways. Volatility, that is implied volatility, is very high when the market goes down. And so that's definitely a good time to sell options because they're trading at a much higher value due to the increased risk when the market goes down. And usually when it goes down, it tends to go down fast. So now let's talk about how to generate income when the market goes down. So one way is by the capital gains that you can get in a stock. For example, let's say if the stock is at $40 and it's going down to 10. Instead of going long on a stock, you can short the stock. So to short the stock, you're selling it first only to buy it back later. But how can you sell shares that you don't own? Well, the way you would do this is you would borrow shares from your broker. You borrow shares and then you go to the market, you sell it at 40, and then when it goes down, you buy it back at a lower price at $10, and then you return those shares back to your broker. In this case, you're experiencing a gain of $30 per share. But shorting the stock has risk because if it goes up, your potential losses can be huge. It can be greater than your original position. For instance, your original position is $4,000 if you sell 100 shares at $40. But if the stock were to go up to, let's say, 200, you would have to buy back 100 shares at $200, which means you have to spend $20,000 to buy those shares back. But to protect yourself against that, if you're shorting the stock, you can buy the call option because the value of the call option goes up if the market goes up. So that's how you can protect yourselves from huge losses in the event that you short a stock but it goes up instead of going down, is by buying a call option to protect the number of shares that you have invested when shorting the stock. For those of you who want to see a mathematical example on how to protect yourself when shorting a stock, on my Patreon page there's a video. You may have to scroll down to find it, but there's a video entitled how to protect yourself when, or how to protect your trading account when shorting stocks. So it may be wise to look at that if you want to understand how that works. But now let's continue with this problem or this scenario. Another way in which you can generate income if the market goes down is rather than shorting a stock, you can go long on a put option. the value of call options go up when the market goes up, and the value of put options go up when the market or the value of stocks go down. So imagine buying a put option for $5 and then selling it for 20 as the value of the stocks go down, or the underlying stock goes down rather. In this case, you're looking at an ROI of 400%. Whereas shorting the stock, you're looking at an ROI of 75%. If it moved in your favor, in this example, you're receiving $30 for the $40 that you had at risk. So that's an ROI of 75%. When shorting a stock, the maximum theoretical ROI is 100%, assuming the stock goes all the way to zero. Unless the stock could be negative in value, your maximum ROI is 100%. But when going long on a put option, your ROI can be greater than 100%. The downside with a put option is the same as buying a call option. Options, they have an expiration date, and you need to be right about not only the direction of the stock price, but also the time in which it moves. And also you have to consider volatility, because volatility tends to be high when the market goes down. So buying put options when the market goes down is they will be very expensive because volatility is usually high at that point, which makes it hard to profit from buying put options when the market goes down, because you'll be paying a high premium for buying the put option. But it can still work if it moves in your favor. Now, another way in which you can profit if the market goes down is by selling a call option. It's by going short on the call option. So imagine selling the call option at $10 and then buying it back at $1 as the market falls. Now, the good thing about this is when you sell it, volatility is high, and so the value of the call options and the put options will be very high at this point. So if you go long on the put option, you're buying a put option when volatility is high, which kind of works against you. And then you're selling it later, which the volatility could be lower at that point. But when you're shorting a call, you're selling it when volatility is high. So you're getting a higher premium because of the increased price due to volatility. When volatility goes up, the value of both call options and put options go up. So it's a good time to sell options when volatility is high. But it's better to buy options when volatility is low. So when dealing with options, it's important to take into account the effect that implied volatility has on your options. But going back to shorting a call, let me keep this in. If you were to sell a $10 call option, since it controls 100 shares, you will be receiving 1,000. And then if you buy back at $1, you would spend $100 to buy it back. That should be a negative value. So in this example, you're looking at a gain of $900. Of course, you can short multiple call options to increase that. In the case of the long put option, if you were to buy it at $5, you're putting in $500. And if you sell it at 20, you're getting back 2,000. So you're looking at a gain of 1,500. And then if you're shorting the stock at 40, using 100 shares, you're receiving 4,000. But then you're going to spend 1,000 to buy it back. So you're looking at a gain of 3,000. So in all three of these scenarios, you can generate income when the market goes down. You can short the stock, you can go long on the put option by buying it and then selling it later, or you can short the call option by selling it at a high price and then buying it back when it falls. Now, to short the call option, you can either sell a covered call option, which means you need to own the stock and the value of that stock is going down, which is not good. Or if you short a naked call option, then you don't have to worry about the decrease in stock price. But if the stock goes up against you, that will be a bad thing if you own a naked option, because then you you put yourself at risk to buying it at a much higher price. So let's say if you short a naked call, and instead of the stock going down, let's say it were to go up to, let's say the stock were to go up and the value of the call option went to 50, which could happen. So you received 1,000, but now you have to buy it back at $50 times 100 or 5,000. So if you're shorting the naked call, it's pretty much equivalent to shorting a stock without protection. If the market moves against you, you can spend more than what you're getting. So here you're getting 1,000, but if it goes up to 50, you have to buy it back at 5,000. So that's the dangers of shorting a naked option, and even shorting a put option if the market goes against you. But if you short a covered call option, you don't have to worry about that, because if the market were to go up, the value of your shares will go up, which will negate the fact that you have to buy back the call option at a higher price. So a covered call option will protect you from the risk that the market moves against you. So there's a lot of information that we've considered so far. Thus, let's see if we can summarize the important details. So remember, when the market goes up, the value of stocks go up, and the value of call options go up as well. But the value of put options, they go down in a bull market. So to generate income when the market goes up or in a bull market, you can buy the stock at a low price, sell it at a higher price. You can buy the call option at a low price and then sell it at a higher price. Or you could sell the put option, or even sell a covered call option. And remember, if the market goes sideways, you can still generate income by owning dividend stocks, or you could generate income by selling options. But just keep in mind, volatility will be low, so the prices of options will typically be low during this period. And then the last situation is when the market goes down. When the market goes down, the value of stocks go down. The value of call options goes down as well, but the value of put options, they will go up. So to generate income in a down market or in a bear market, you can short the stock, that is, you sell it at a higher price and then buy it back at a lower price. You can also short a call option. You can sell a covered call option, sell it at a higher price, buy it back at a low price. Or you could buy a put option. You buy it at a lower price and hopefully sell it at a higher price. The only risk with that is volatility is high, and so you'll be buying put options when the prices are high. Thus, it'll be hard to make a return on buying put options when the market goes down. But it can still work if the value of the stocks is really moving down fast. So those are the different ways in which you can generate income regardless if the market goes up, sideways, or down. Thanks for watching.